Hello and welcome everyone. My name is Bobby Thompson and I lead Visa's Global Government Engagement team. We are absolutely delighted to sponsor the Congressional Black Caucus Foundation's annual legislative conference and celebrate the 50th anniversary of the CBC. Visa has been a proud sponsor of the annual legislative conference Phoenix Awards Dinner since 2015. We're excited to be with you here virtually today and optimistic that we'll have the chance to be together in person next year. On behalf of Visa, I want to extend our sincere thanks to Congressman Greg Meeks for his invaluable leadership as chairman of the House Foreign Affairs Committee and as a long-standing member of the House Financial Services Committee. Chairman Meeks has been a strong advocate of financial inclusion and economic equity throughout his entire career. We were fortunate at Visa to have him participate in a financial literacy football event in New York City with local high school students just a few years ago. The topic of today's forum is more important than ever. COVID-19 and the economic crisis has put a spotlight on the high and rising levels of inequality in the United States and exposed troubling disparities in how people and small businesses can access and use digital technology. It's also exacerbated the significant barriers many communities must overcome to receive the benefits of digitization. At Visa, our mission is to connect the world to the most innovative, reliable, and secure payments network. And we're committed to advancing inclusive, sustainable, and equitable economic growth in all communities. We know that real change and meaningful progress toward eliminating barriers to economic success for individuals and businesses requires a long-term commitment and structural reform. Through our collaboration with the Congressional Black Caucus and others, we can bring about positive change to drive inclusive economic growth. That's why I'm especially pleased today to share that we recently launched the Visa Economic Empowerment Institute. VEEI brings together experts in the fields of payments, economic policy, technology, security, international trade, and economic development, and will serve as a forum for policymakers, regulators, and non-governmental organizations to convene and collaborate on policies to rebuild and grow the global economy. Again, we are thankful for the opportunity to welcome this esteemed panel and celebrate the CBC's 50th anniversary. We look forward to continuing our work in partnership with the Congressional Black Caucus Foundation to reduce economic inequality and by collaborating on inclusive efforts that will support everyone, everywhere. Thank you so much.
Good afternoon. For over a decade, it's been my honor to host this forum on wealth building at the Congressional Black Caucus Foundation's annual legislative conference. This year's discussion comes as we continue to respond to and recover from COVID-19's ongoing economic and health threats that have disproportionately impacted Black America. During this year's conversation, we will specifically focus on the Federal Reserve's policies and their impact on income and wealth inequality, while also considering what central bankers are doing globally to tackle similar issues. There's no question that the Federal Reserve played a critical role in our pandemic response through its monetary and supervisory roles. The Fed served as the lender of last resort to banks, making short-term loans to financial institutions. Accordingly, banks have fared pretty well in spite of the pandemic challenges, allowing them to extend relief to American households and businesses. The Fed allowed foreign central banks to swap their currencies for US dollars so that those foreign central banks could support their financial institutions. This only further demonstrated how interconnected the United States economy is with the larger world. The Fed set up lending facilities to support certain industries, serving as a lender to state and municipalities, mid-sized businesses, and nonprofits. At the urging of Congress, the Fed went much further than it did during the 2008 financial crisis to support non-financial businesses and localities and remain the lifeblood of our economy. The Fed also lowered interest rates to stimulate spending, which was important since the United States remains the world's largest consumer market. Fed policies supported record low interest rates in the housing market. For example, where we saw a refinance boom that helped certain homeowners lower their monthly payments, adjust to lost wages, support other struggling family members, and better plan for financial stress. Still, those who benefited from record low housing rates were disproportionately white, while Black and brown homeowners saw their share in the refinance market contract. We entrust great powers in the Federal Reserve, which allows it to play an outsized role in our economic recovery during times of financial stress. However, with great power also comes great responsibility, making discussions like what we will have today critical. A key question for policymakers like me remain: what more can the Federal Reserve and the central bankers do globally to ensure that the benefits of their policies are more evenly distributed among various American communities? In the United States, this is a key question in light of our persistent issues with racial inequality in income, wealth, and economic opportunity. That is why I'm so proud to host our lineup today. From labor to academia to financial consulting, we have a panel that is diverse in thought and diverse in background. And accordingly, I want to thank our panelists for joining us today. Karen Petru, Chris Brummer, and Bill Spriggs. They may express different views today, but what strings this group of panelists together is their shared commitment to ensuring that the least of these benefit from our economic policies. That is also a commitment of mine, and it is the basis for this annual forum on wealth building in Black America. We also have a dynamic moderator, and Renita Young, a broadcast journalist and content creator who covers personal finance and business entrepreneurship through the lens of culture. She is a New York-based correspondent for Bloomberg Radio, TV, and Quick Take. She's been on the beat recently, covering the Minneapolis Fed's racism and economy events and interviewing Atlanta Fed President Raphael Boston. With that, I now will pass it on to Renita to introduce our dynamic group of panelists and begin our discussion on central banks and global inequality with a specific focus on the Federal Reserve. Renita, I turn it over to you.
Congressman Meeks, thank you so much for that lovely introduction, and welcome everyone to our conversation about global inequality and central banks. Let me introduce you to our panelists. First, we have Karen Petru. She's the co-founder and managing partner of Federal Financial Analytics, a privately held company that since 1985 has provided analytical and advisory services on legislative, regulatory, and public policy issues. Petru is also the author of the book Engine of Inequality: The Fed and the Future of Wealth in America. Next up, we have Chris Brummer. He's a Georgetown law professor and author who lectures widely on financial inclusion and equity, financial regulation, and global governance. Brummer now serves as the faculty director of the Institute of International Economic Law. He most recently was a member of the Biden-Harris transition team, assisting in leading work streams relating to financial technology, racial equity, and systemic risk for the Treasury Art. And last but not least, Bill Spriggs is a professor in and former chair of the Department of Economics at Howard University and serves as chief economist to the AFL-CIO. He's also currently on the advisory board to the Minneapolis Federal Reserve Bank Opportunity and Inclusion Growth Institute, and he's on the editorial board for the Journal of the Center for Policy Analysts and Research of the Congressional Black Caucus Foundation. Now, let's get started. Economists have pointed to several factors that contribute to income and wealth inequality, including globalization, technological change, and changes in the labor market. They argue that these changes and challenges tend to be structural and long-term, thus not best addressed by monetary policy, which tend to have short-term effects. However, there's been a growing pushback on the idea that monetary policy has limited impact on inequality. My first question to you, Chris, where do you all stand on the topic?
I think it's pretty clear, at least from the standpoint of economic history, that at a minimum, monetary policy can increase inequality. Now, part of this has to do with the question of, well, what exactly is monetary policy and sort of what is its effect, but also there's a deeper question about how exactly do you consummate, how exactly do you execute different kinds of monetary operations, and really what are the rules to the game. But I think that maybe it's just better to start off at a 10,000-foot level and let the real economists sort of chime in on this particular question, just by saying that inequality can often be exacerbated by certain kinds of economic conditions like inflation. And when that happens, monetary policy can either respond to, it can exacerbate, or it can mitigate these kinds of economic conditions. And historically, we've seen that, when it comes to things like inflation, not everybody can navigate it with the same degree of efficacy. Higher income individuals, for example, tend to be a little bit better at negotiating their salary in a high inflationary environment. When you look at historically the growth in the size of luxury goods, economists have noted that different firms offer different kinds of products to different segments of the population at lower inflation rates, given whatever are the sort of driving dynamics of these sub-markets. And also over time, we've seen that when, for example, responses are levied, let's say if you want to raise interest rates, well, historically, Black unemployment tends to increase more than white unemployment. So this is a very roundabout way of saying monetary policy matters because the economy matters. And there are certain kinds of assumptions that are often baked into monetary policy, and assumptions about the trade-offs that can be involved in either allowing inflation to rise versus, say, allowing the economy to accelerate. That can nonetheless have very disparate implications and ramifications for different people, depending on both their socioeconomic status and also race.
Karen, where do you stand on this topic?
Well, I agree with Chris. I would add, I think it's not an either or. There are structural factors that clearly affect economic inequality. You mentioned a lot of them, Anita. The globalization, education, I would add discrimination, structural issues, but that doesn't take the heat off monetary policy. It's short term, but short term is critical because it leaves in place long-term unequal effects. That's why I called my book Engine of Inequality, because while there are these profound long-term factors that create inequality, tax policy is another. Nothing moves money with the power of a central bank, and it moves it fast. And the longer it moves it in one direction towards wealthier households and the financial markets, the more unequal we get, and the harder it is for fiscal policy, dealing with taxation, dealing with trade, dealing with education, dealing with justice. We get harder and harder to catch up. And that's one of the reasons this country has been getting more and more unequal.
Thank you for that, both of you. And Bill Spriggs, you're the economist in the room. Where do you stand on this issue?
I think it's important to remember what the monetary policy does. It provides the liquidity for the system. So think of it as putting water in the tub, and you rise and you fall. For that reason, many people think it has nothing to do with equity. It's the structures within the economy that generate unequal outcomes, given that you're providing in a way, or in an essence, think of it providing an opportunity for the economy to grow. So the path by which the economy grows is either, fair or unfair, but that path isn't what the central bank does. I vary from that in the sense that on the margin, does a slower economy or a faster economy have disparate impacts on the structures? So when we have loose labor markets, when unemployment is high, the cost of discrimination is exceedingly low. And that has real impacts for Black workers that Black workers cannot overcome. And any policy aimed at addressing discrimination is weaker in the presence of high unemployment, simply because employers don't have to respond. They can continue to discriminate. So my view of it is, what are the correctives? If the economy grows, the structure of our economy is that rich people get richer. That is the structure of our economy. And so disparities on the wealth scale get bigger when our economy grows. And so you have to think of this also from absolute versus relative problems. In absolute terms, the abject position of Black workers who live paycheck to paycheck, who have no liquidity, high unemployment is disastrous. And so in absolute terms, Black workers benefit greatly from policies that make it more expensive to discriminate and easier for them to find jobs, and as a result, close wage gaps between Blacks and whites. That's what tight labor markets do. In relative terms, Blacks are worse off because when the economy expands, those with the assets to benefit from that growth benefit by large amounts. And so it's, do you want to be poor and happy because rich people aren't doing so well? Or do you not want to be poor and worry about what do I do with rich people because at least I'm eating and I have a roof over my head? So I think that's the way you have to think about this. And the problem is that the Fed can't solve the inequality from the assets. We can solve that on the fiscal side. We're not supposed to be partisan, but there's legislation pending to have a fairer tax system so that we can tax at a much fairer rate those with high incomes, and we can return to taxing capital income so that we can make the system operate more fairly. There are a lot of people who believe that we should tax wealth, not just tax income. And at the local level, of course, we do that. Most local governments are funded heavily by real estate taxes, which are really a wealth tax. So there are different ways of combating the inequality that results from growth. There are few ways of combating the abject problem faced by the millions of Black workers who have no liquidity and must have a job in order to get ahead. I would add, if you imagine a world at high interest rates and high unemployment in which Black people get homes, that's an interesting world. You're raising the cost of Black people qualifying for loans. You're making them unemployed, which means they won't qualify for loans. And so the mechanisms for closing the wealth gap become that much more difficult in a world in which the entry into home ownership is being blocked. So I think that's the complexity of what we're talking about here.
Well, now that we've established a baseline of where you all come from with this idea, with this issue, regardless of where you fall on it, there's no question that monetary policy can have a broad impact on the overall economy by supporting the labor market, especially during recessions, which we definitely are in right now. And some people argue that monetary policy's ability to lift all boats should really be a sufficient goal for central bankers, regardless of those distributional effects of those policies. So next question, what are your thoughts on that traditional view of the Fed's role in the economy and its future given changes in economic politics? Toss up for anyone.
I'll start if I might. I think that was true. When this country was a largely middle-class country, most votes, not all, because the structural factors still held Black people down, but we had a Black middle class and votes rose a lot better than they do now. Monetary policy has changed dramatically. In 2008 and 2010, it became, quote, unconventional. And we have interest rates now down below zero when you take inflation into account. We have a Fed holding assets equal to 1/3 of gross GDP. And we have a tremendous safety net. The Fed is now propping up the financial markets in ways it never did by virtue of ultra low rates, the portfolio, and the way in which it both regulates and intervenes in the financial market. That is a financial system in an unequal economy that really benefits the top 10% and mostly the top 1%. The top 1% of this country gained $10 trillion in wealth year over year. And then during a pandemic, you look at what happened. And it's because the markets are rising fast and no one else is rising. The Fed focuses on the markets, not on shared prosperity. It used to be able to use these conventional tools in an equal way, but the old tools now work very inequitably because the economy is so profoundly different than it was when old models for monetary policy, the old models the Fed still uses, were established. We're just a different, much more unequal country now. And low rates do much more damage than we understood. And people in the markets do fine. Anyone trying to save for a down payment has years to go because any money you put in the bank, and that's how lower income people save. They're not buying reverse repos. They're putting their money in their local bank or credit union, and every day you save, you lose with rates below zero after you take inflation into account. Makes it hard to buy a home, to accumulate the wealth Bill talked about, hard to save for retirement, hard to even have a rainy day fund. 40% of this country doesn't even have $400 against a blown tire. So things work differently now because this nation is so profoundly unequal, and monetary policy plays a huge role in, I think, making that worse. There are other things we need to do too, but we have to move fast or it'll get worse fast, and that's really a dangerous situation.
I'd actually like to kick that same question back to Bill. What are your thoughts on this coming from the economist's perspective?
The big U-turn in equality started in the 1980s when the Fed changed its position on full employment and pursued with vigor the idea that the most important thing was price stability. And under that regime, since the 1980s, inequality exploded. One of the major ways in which inequality was allowed to explode was higher levels of unemployment. The average level of unemployment is 1.5 points higher. And then since the 1980s, is that lowers the bargaining power of workers. It makes it harder for workers to form unions. It makes it harder, as I mentioned before, when it comes to discrimination. So the path of inequality that we've been on actually started in the 1980s when the Fed decided that the most important thing was price stability. That has generated nothing but inequality. Now, the real change was the repeal of Glass-Steagall and the inability of the Fed to step in to introduce regulations to rein in Wall Street. So the result is, before, when the Fed would ease credit access, the main way in which the Fed could make that happen was through commercial banks having an easier time of lending. Now, of course, beginning in this century, when the Fed makes capital more accessible, it makes it possible for it to be on Wall Street, not on Main Street. That's a regulatory position that the Fed has changed, not so much policy on the money supply, but being indifferent whether the money makes it to Main Street and therefore is accessible. Think about the subprime market collapse when it came to housing. That money did not come from commercial banks. That was not the Community Reinvestment Act. That was unregulated money from Wall Street that caused the subprime crises. And so it's that portion that generates all of this inequality. That's really a regulatory question, and the Fed hasn't stepped to the plate sufficiently to return banking to its focus of Main Street. But this out of hand wealth that we're generating is this machine that started in the 1980s, the weakening of the labor movement, the globalization of capital, not globalization. We always lived in a global economy. There was trade from the Bible, right? I mean, we have lots of historical records that many of us are familiar with of global trade. The globalization of capital is what we have changed, and we have introduced rules to make the world safe for capitalists, not safe for capitalism, not safe for growth, safe for capitalists. Totally different thing. So I think we have to understand, because of the excess supply of savings in the world, interest rates globally are lower, are trending lower, and the space that the Fed currently has to raise rates is very limited. In 2013, when the Fed started raising interest rates to try and get back to normal, it slowed the economy dramatically. The Black unemployment rate started to go back up because at even low interest rates, the auto industry slows down in the United States by a huge amount. The fact that interest rates globally are falling means if you look at where's the point when the Fed raises interest rates that the economy slows, that interest rate is also falling. And so even that little step that they took in 2013 was a step too far. Even the little step they took in 2017 was a step too far. Fortunately, the Fed understood that they were about to create a catastrophe in 2017, that the Black unemployment rate was about to go out of control, and the rest of the economy was going to tank. And they went back and in response to that, lowered interest rates. They just don't have as much room on the upside as people think they do. And in large part, that's because of the high level of inequality we have. And so you can't fix that so easily unless you keep labor markets tight, unless you keep workers employed, unless you have a path for workers to have bargaining power and leverage. Through fiscal policy, we've been able to do that in the depths of this weird thing we're going through because of the pandemic. Fortunately, household balance sheets have improved because of fiscal policy. And as a result, workers are making far more rational decisions about employment and which employers they're going to return to. And that's just hard to replicate. It's easier to replicate if you just have full employment.
Now, there's one side that we haven't even scratched the surface of yet. And on this side, the political side, both major parties have argued for the Federal Reserve's independence from politics. And my question to you, Chris, is are there concerns that as central banks begin to examine their role in addressing socioeconomic issues, that they might open themselves up to partisan debates that essentially threaten their independence?
So that is a great question. And if you don't mind, I'm just going to back up because I did want to just sort of add something to, the great analysis that was just provided. And I think it's useful to get a couple of concrete examples, and also just getting back to your original question, it's like, does monetary policy contribute in one way to inequality or not? Well, it's not just that the decisions that you make may have trade-offs. Certain groups may benefit more than others just from let's call it a macroeconomic perspective. But also there are trade-offs that are embedded in literally how you effectuate monetary policy. So let's just use Professor Spriggs's earlier example, even going back to the Great Recession and sort of the collapse of Wall Street, in 2008. Well, and getting back also to Karen's analysis with this unconventional, Ms. Petru's analysis of this unconventional monetary policy. Well, one of those, the traditional tools of lowering, interest rates through a certain series of transactions, well, that was kind of replaced by a more direct intervention whereby the Fed itself was directly intervening in markets and buying up assets, very often buying up the bonds of large banks, financial institutions, and that sort of process of asset purchasing has expanded, beyond even those original sort of Wall Street banks. Now, when the Fed intervenes, it may be doing so from the standpoint of preventing catastrophe. The idea of saying, well, we want to, for the purposes of price stability and, given certain kinds of systemic risks in the economy, we have to intervene in the economy. Now, even when you do that, however, when you are intervening and buying up assets, you are helping to prop up the price of those assets, which means that people who own assets are getting a kind of a benefit of some sort from the government. And if you extend those unconventional sort of tactics when it comes to the effectuation of your monetary policy, you have a world where people who own assets are actually getting a kind of government subsidy of some sort via the Fed, because the Fed is offering and is providing a kind of backstop, is a purchaser of those assets. It's a source of demand for many of those assets. Now, again, you can come up with a variety of explanations as to why there may be certain advantages for that particular way of conducting your monetary policy. But if you're not keeping an eye out on what the sort of disadvantages are, and that is certainly in a world of very wide racial wealth inequality, what you're ultimately doing is literally just by conducting your monetary policy, you're helping to exacerbate the wealth gap between blacks and whites and the rich and the poor. And this is just literally just in terms of the way in which your monetary policy is being conducted. Now, I'd like to go a step further there, because I think it's really useful for the audience to sort of get to really dig into this question then. Okay, if there are potentially, and this is just, again, one aspect of the conduct of monetary policy, but it's a useful example. If you are seeing this, then are there conversely tools that are potentially in place for the Fed via the conduct of its monetary policy to help to dig at or sort of think through new ways of supporting historically marginalized communities? Now, again, the old school way had to do with, well, can we adjust our interest rates in one way or another in hopes that if you can drive up or accelerate the economy, it makes racial discrimination less economically sound. It hurts more to discriminate when you kind of have to bid for workers, and so you may be less inclined to discriminate. Well, in a world where you're actually, again, in a world of asset purchases, there are still tools that are available, and I think deserve at least some thought by policymakers. And here's where I guess the political question can enter into enter into some discussion. But ultimately, if you're purchasing bonds, it's worthwhile to ask at least whose bonds are you purchasing? Um, are you purchasing bonds of companies that have taken strides to diversify, to employ certain kinds of practices relating to diversity, relating to the treatment of their workforce? Is the Fed caring at all about that particular question when it's engaging in those asset purchases? There are questions in terms of, again, if the Fed is intervening and buying bonds, it's effectively relieving risk from certain kinds of dealers, in the market. Well, what do those dealers look like? Is there access to minority-owned dealers in those transactions? When you think again about bonds and bond purchases, are we thinking creatively, given certain kinds of distributive consequences of asset purchases, to make sure that the entire economy is able to benefit on equal terms? Have we thought about maybe buying bonds from minority depository institutions and CDFIs that tend to service rural and Black communities, right? And minority communities. These are the kinds of questions that are, even in, let's call it, the second best world of unconventional monetary policy, that are probably useful to ask, to the extent to which they may exacerbate even more the trade-offs and frankly the disparate impact of some of our monetary policy. And again, this goes into the nooks and crannies, the auto mechanic kind of view of monetary policy, but it's extremely important even beyond sort of, again, this macroeconomic standpoint. And these are questions that are, in my view, too infrequently asked.
Chris, I want to stick with you for this next question, because we do have an example of a central bank that's at least examining its role in inequality. And so earlier this year, the Bank of Canada noted that its quantitative easing programs may exacerbate inequalities, and they've been reviewing their impact accordingly. And so are there other central banks that you know of that are taking a more forward look at leveraging monetary policy to address these inequalities?
Yeah, it's interesting. I'm a lawyer by training, and being a law professor is my day job. I think that reading the headlines, you do see examples, or at least talk and rhetoric from unusual examples. I mean, in China right now, there's a shift, not just in the PBOC, but writ large, to think about inequality. But of course, there's an entirely different political overlay there. What I will say, and I'd be curious to get the others in their view in terms of how they've seen other central banks, is that what you do see is that other central banks are thinking in very real terms about diversity. Now, part of it, that the first sort of trend, and this coincides with ESG questions that you see not just at the Fed in the United States, but also with the SEC and some of our market regulators. But you do see, by the way, in some countries, sort of climate metrics that are ultimately now seeping into the conversation as to how central banks are conducting their monetary policy. And this goes back to my original observation. Well, if we're going to think about both climate risks, climate opportunities, the role of monetary policy in terms of either minimizing or exacerbating climate risks, should we also think about these other risks to society that ultimately can frankly undermine price stability, to the extent to which you have less social cohesion and other problems sort of percolating up to the top politically. Are there other kinds of things that the Fed can do, and other kinds of metrics that can be deployed? You do see that conversation usually against the backdrop of gender diversity in some countries, particularly in Europe. But I think that the peculiarities of the American experience allow for other opportunities to sort of explore and to adapt and to learn from what some of those other central banks are doing in order to, again, make sure that our central banking and central banking policy is as fair as possible, and frankly, is being conducted in a way that's going to ultimately grow the economy the most.
You know what, I want to ask Karen the same question because I'm interested in knowing how not only central banks can look at leveraging their monetary policy to address these inequalities, but in some cases, just leveraging their influence to be able to do so. Karen, what do you think?
Well, I think it's an important question. I would go back to what Chris just said about we call it the peculiarities of our system. I don't know what you might, we're different. And some of that is by difference of obviously very different diversity in this country than others, but there are also other factors. For example, the European Central Bank has done a lot of work looking at its economic inequality impact, as the Bank of England. And the Fed, I wish, was open to inquiry as these other central banks, because its position is essentially in us. And I don't think that's a very intellectually honest or rigorous one. But for example, you can look in Europe, all mortgages automatically adjust. So when rates drop, mortgage costs drop, and therefore housing costs drop unilaterally. In the United States, when rates drop, you have to go refinance your mortgage, and there are profound inequality impacts. Black people don't get refinanced mortgages. They pay for more for their mortgages up at the start, and they refi at a lot lower rate because of a variety of embedded discriminatory practices, as well as obstacles like credit scores, or a variety of issues, low home prices in minority neighborhoods, and we just don't transmit monetary policy the same way as other central banks. So I think we need to look at the United States, in a sense, in our own right, learn from others, but we are different. And to your question, I think it's really important about political choices, and would the Fed be made more political if, for example, it bought green bonds, as Chris is suggesting, or operated what other people call a people's quantitative easing. And I have some thoughts about that, but I want to step back. I mean, the Fed is already making what is both a monetary policy, and also a political decision, because it's supporting financial markets. In March of 2020, when COVID hit us very, very hard, the Fed rushed in and supported the money market funds. It supported the financial system. And that's because the Fed's mission is liquidity support. But you know what? We had a broad liquidity crisis in almost every American house. And I proposed in 2020 that the Fed think about its mission more broadly and laid out what I call the family financial facility. Because a lot of households had liquidity problems. And why were they suffering with significant and even profound food shortages, basically because of short-term liquidity problems? But we bailed them. Junk bond exchange traded funds and money market funds, and the Fed stepped in and propped the market up. But the rest of the economy was experiencing an acute liquidity crisis. I've also suggested, I think Bill's point about regulation is important. I've also laid out a charter for something I call an equality bank. The Fed has tremendous power to look at its rules. Some of the risk-based capital rules that are huge drivers, this is very technical, as you said, auto mechanics, but the capital rules that the Fed sets for banks determine who gets a loan and how much that person pays for it, and whether they can even get it from a bank. And banks have largely stepped back from consumer financial intermediation, and now it's in payday lenders, many non-banks, higher costs, often higher risk lenders. And I think we need to return to a system of regulated consumer finance, and with special charters designed not only to make it so, but to be sure that those charters, these equality banks, do what they're chartered to do, and that don't just make themselves rich at everybody else's expense.
Karen, you brought up liquidity, which is part of the Fed's dual mandate. And so, Bill, I wonder from you, taking into consideration what we just talked about, where do you see this debate going globally?
Well, globally, let me step back just 1 second, because your question about is it political or politicization if the Fed is concerned about the outcome in the labor market? That the main mechanism by which the Fed in the past has gauged, is it making inflation more likely, has been, is it in fact making workers more powerful? And at low unemployment rates, workers get to demand higher and higher raises. And the interpretation has been, let's not have that happen. The interpretation for most economists, 90% of them, I would say 98% of them, I might even say 99% of them, is that the Black unemployment rate has everything to do with Black people being inferior workers. And not necessarily because these economists are racist, but they all believe our schooling has made us inferior, our neighborhoods have made us inferior, we are inferior. And therefore, if you want to improve Black labor market outcomes in their eyes, then fix the schools, fix residential segregation, fix those things. You have to fix Black people. The reality is that the number one reason Black people are unemployed has everything to do with discrimination. If Black people had the same unemployment rate for the same level of education, we wouldn't be having this discussion, because even though whites have a slightly higher share with college degrees, that doesn't drive the Black-white unemployment gap. The Black-white unemployment gap is driven by the fact that a white person who has dropped out of high school, who has never completed their education at the elementary school level, has an unemployment rate lower than the Black unemployment rate. That is the level of discrimination in our labor market. And so their view is all based on this notion that Black workers are inferior and that's what drives this, and you can't fix that, when in reality, it is discrimination that drives it. And so when you look at what the Fed has consistently said is, what's the unemployment rate that threatens inflation? They're way above what we have been able to actually see in the labor market without generating inflation. Way below that. The difference is measured in millions of people who are able to have jobs because the Fed didn't slow the economy. And of those millions of people, way disproportionately, of those millions of people are hundreds of thousands of Black people who got jobs that would have been denied employment opportunities. The whole of the 1980s, this mythology kept the Black unemployment rate in double digits for the entire decade. Black people never saw single-digit unemployment rates, only because the Fed refused to believe that the unemployment rate could fall below 6%. So to your question, other central bankers have, as Karen has pointed out, and as Chris has pointed out, have looked at issues by gender because they collect data by gender. Europe is in utter denial that they have a race problem. So they don't have data for it for historical reasons dealing with the Nazis. So they don't collect data by race to protect themselves from repeating that horror. But they do collect data by gender, and they concentrate on gender. And people have raised these other issues. Karen and Chris both raised excellent points. The Fed is constrained by its own view, but also by legislation and what bonds it can purchase. One could imagine, as Chris suggested, a world in which we create it momentarily to give the Fed greater room to buy public debt. The Fed holds federal debt and federal guaranteed debt. And the biggest federal guaranteed debt, the market for intervening, is mortgage-backed securities. There isn't a big federal backed pot of money otherwise. The small business loans are federally backed, but that's not a big enough pool of money to affect policy. But one could imagine if the Fed had greater leeway on state and local debt, that it could buy those bonds and keep interest rates low for public investment. Or as Karen pointed out, the Fed did intervene to save the money market funds because their lack of liquidity was threatening the system. And the Fed looked at that systemic risk differently, as Karen pointed out, than the systemic risk that households face because we've stopped forcing commercial banks to be commercial lenders. And we saw that when the Fed was given a pot of money for Main Street lending to save small businesses during this crisis, and the banks refused. They refused to lend the money, even though they were underwritten by this pot of money, and the Fed was trying to encourage them. And eventually the Fed had to go to CDFIs and other entities that had the guts, the DNA to lend to actual small businesses in real communities. This is a big this is a big question where the Fed could lead as the representative of the banking community to remind us how deeply the banking community failed us in this crisis. The PPP loans really should not have been necessary. As Karen is pointing out, it was clear that small businesses were stressed with a liquidity problem, and the banking community failed to deliver. The capital requirements that Karen brought up, the systemic risk that the banks have, the Fed could have an escalating clause on the capital that banks have to hold to make sure that those that present a systemic risk actually do have sufficient capital to guard us against it. There are a lot of regulatory steps that could move us closer to something that could be more neutral. But a lot of this can be corrected on the tax side. There is no reason for us to have Amazon paying zero taxes. This makes no sense to anyone, how one of the most profitable corporations pays zero taxes. And there are a lot of other ways we could fix this on the fiscal side. I fear when people go and think of the Fed as the economic actor and ignore the responsibility of our fiscal authorities, it creates dangers. On a green economy, as an example, simply making it more expensive to invest in carbon producing industries does not address the issue of just transition for the economy and for the workers who would be affected or the communities that would be affected. And so I fear that people, when they put too much on the Fed or too much on monetary policy, ignore the balancing act that policy needs to do. The impact of trade needs to be corrected through fiscal policy. The lack of investment in our schools is a fiscal question. So I think we should guard that we don't get too much into, we want the Fed to do everything. And remember, they're not elected. And so you should guard against what happens if these unelected people do have all that authority and really do tilt it in a way you don't want them to tilt it. How do you recall them? How do you get them out of that? So I think, we want to have a balancing act. And for that reason, those of us who want a more progressive set of policies should also want to guard against things that really are political and really should be solved using fiscal policy.
Can I just jump in just because it is useful, because it's there's so many that are very helpful. It is worth noting. I mean, the Fed, has been in the market for corporate debt too, and that's what makes this a very interesting kind of conversation, I think, when we get into questions of again, who's benefiting from from Fed monetary policy. I mean, the Fed has purchased Microsoft, Visa, Home Depot, It's active through ETFs with Goldman Sachs, with Apple, right? So there are things in a pretty real way where the Fed is getting involved in this. I guess it takes us full circle, in our financial markets, and the question is, both you can have a philosophical conversation. Should it? But even if you come up with this where you say, well, the economy has somehow changed and it should, I mean, there's still a very clear disparate impact because it ultimately helps to subsidize those who already own assets, right? And I do want to echo this great point that Professor Spriggs just made, which is, you don't want to put all the onus on the Fed. I think I would just take it in a slightly. I think fiscal policy is enormously important, and so is tax. But I also want to say that we unfortunately tend to focus our regulatory scrutiny almost entirely to the Fed when there's a range of other regulatory actors in Washington, D.C., whose decisions also could have a dramatic impact on the economic welfare of Black Americans. And really, I think that my primary concern isn't necessarily that we're overemphasizing the Fed because we're taking it away from fiscal policy, but it's more or less, well, it's also taking our attention off the ball from, again, a range of important entities, from the OCC, FDIC, SEC, CFTC, others, whose decisions have a very real impact on everyday Americans and on Black Americans, and equal scrutiny should be directed towards those entities as well.
Thank you, Chris, for your addition to that conversation. And you guys, as we close this out, I have one last question, and it goes to Karen, because you just wrote an op-ed about this topic for Bloomberg. And one of the biggest issues facing the Fed and other financial agencies is the stunning impact of cryptocurrencies such as Bitcoin. The Fed is in fact researching digital currencies. They revealed that in a panel that I moderated with Fed President in Atlanta, Raphael Bostic. And so there's a growing view that low and moderate income households are now frozen out of the payment system. Would a digital currency, perhaps one operated by the Fed, enhance economic equity, Karen?
I think it's a really important question because we're certainly going digital. And I think the answer to that is it depends. So that's why my Bloomberg op-ed laid out the conditions for how to make a central bank digital currency also an equitable currency. And this, I think, points to some of the issues where some of the issues are within the scope of monetary and payment system policy, and some of them are broader. For example, it's certainly very difficult for low and moderate income people to access the banking system cost effectively or fairly. It's even harder to do it digitally. The barriers to digital access are profound by race, by income, and by age. I mean, look at what happened last year when the world changed and kids had to go to school online, and what happened here in the District of Columbia, where the kids all over the city in Southeast, Northeast, not upper Northwest, didn't have laptops, didn't have broadband, rural kids all over this country in poor communities having to go into library parking lots to try to do their lessons. We can't have a digital currency till we have somehow mastered the digital divide and determined how we can provide digital devices with the capacity for people to bank on economically, and I would say accessibly. I'm blind, and whenever I hear people, I sit on lots of panels talking about digital currency, and these kids are kids, because I'm older too, are always waving these phones around, all the cool stuff their phones do. None of those applications are accessible to people with a vision impairment. They just aren't. I tell you right now, I can't get groceries. There is no application on a laptop or on my phone that allows me to get groceries with a vision impairment. Full stop. So we have huge issues with access to basic services for people with disabilities as well as older people. who may not be comfortable online, face economic barriers to online access, and who just aren't ready to learn something new, but they still, of course, need access to the payment system. We need to design a digital system. We need to design it with not just equity, but also access at the front of our brains, not as an afterthought. And I feel, as you can tell, really strongly about that. If we freeze people already facing severe economic inequality and employment challenges out of the banking system by virtue of premature digitalization, or if we expose them to unregulated providers of payment services like Facebook, and something goes wrong, I said before, 40% of the American population can't handle a $400 expense. What if the paycheck doesn't show up? These are really severe issues as we innovate, and I think we need to move quickly, but also really carefully if we want to keep social justice in mind along with new economic efficiency.
Such a fascinating topic that could really be a panel of its own. But we're out of time, unfortunately. So I'd like to thank our panelists, Karen Petru, Chris Brummer, and Bill Spriggs for joining us, and our sponsors for this panel, PepsiCo, Visa, and the Local Initiative Support Corporation. I'm Bloomberg's Renita Young, and enjoy the rest of your day.